Hello friends, and welcome to my YouTube channel Simply Stocks. And today I'm going to talk about a very different topic. I'm going to talk about 5 sectors that one need to completely avoid while investing. And I'm not talking about trading, I'm talking about 3 to 5 year investments point of view. What are the 5 sectors to avoid? So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position to any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about those 5 sectors, here's a small request that kindly support me on Patreon, and once you do that, it will help me grow the channel, help you also ask me questions in greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and a number of podcasts that I put up from now and then. I put up a podcast on Reliance just today. So kindly support me there and you'll have access to a number of things there. You can ask me questions on stocks, on markets, but for detailed market or company talk or a number of stocks you are holding and you want one-on-one discussion, kindly directly email me. Now about those sectors. So the number one sector in that list is infrastructure. And this is a sector which has been in doldrums for the last 7-8 years. And the reasons for not having this sector, major reason for that is the companies are in losses, and the companies are in most of the companies, virtually 90-95% of the companies are in huge debt. So a sector in total doldrums can only revive when government expenditure on this sector increases a lot, and we have a 7-8% growth rate, not 3 to 4% growth rate that we are struggling at. It has not performed for 12 years. So I was talking about 8-9 years. I think after 2008, when DLF touched I think 2-3 thousand rupees at that point, I think 1200 to 1000 rupees, it has not performed whatsoever. In these 10-12 years, heavy debt a big pain, and most important factor for choosing any company for me is debt. If the company is having debt, reasonable debt is fine, but if the company is keep increasing debt, no matter in which sector it is in, it's a complete avoid for me. And this complete sector is in total debt. Most of the companies are in losses, as I explained, and it can only perform at 6%, even I would say 7 to 8% when the economy grows at that rate. The second sector in my list is capital goods. Now, this is different from infrastructure. So, infrastructure, you have Sadbhav Engineering. I'm not saying it's a bad company. I'm just giving you examples. So, ILNFS, IVRCL, GMR Infra. You have GVK, the infrastructure arm. You have Lanco, etc. So, these come under infrastructure. When I talk about capital goods, it's slightly better as a space, but apart from Larsen and Toubro, I don't see any other company, small or mid cap, which could really stand the test of time. And L&T has done that. But you look at it, that is the largest company in this sector, and yet it has not performed over the last 2-3 years. Since 2017, the performance has not been there. The performance has really been with the large cap IT, pharma, you have consumption, you have telecom, etc., all performing, but capital, even autos have performed, or capital goods have lagged behind. It is really linked directly with infrastructure growth. So if infrastructure really picks up, then goods which are used for infrastructure, you can say growth, will be used a lot. So like capital goods, like large vehicles, like cranes, etc., and other capital goods which are required for capital expenditure. It's as simple as that. So again, a growth, a direct play on GDP, on India GDP and growth, 6 to 8% growth. Again, very few good quality companies in this space. I can only think of L&T at the moment. And you have to understand that companies are bought by large investors when they see growth going forward. It doesn't matter how the performance has been, say 1 year back or 6 months back. What will be the performance, say 2 years from now, 3 years from now? Those are the companies that keep on going up. And I don't see, and many investors do not see any growth coming in the next at least 1.5-2 years in capital goods or infrastructure. The third sector, you can say a section of the market, would be the most of the banks. Now, some banks, and I can name it here, and most of you know about it: Kotak Mahindra, HDFC Bank, to an extent ICICI Bank and Axis Bank. Probably these three, four banks are fine. State Bank of India in the public sector domain on declines is okay, but then you cannot go any further, or you cannot go down any further. So these 4 5 banks are fine to be bought in. Even in those, I would be circumspect, because the banking sector as a whole is going through a very very bad phase since 2012-13. It has not revived, and things are getting worse on the ground. And that I am fearing for those who are invested into banks and who are trying to get into banks now, with the bank nifty going up so much, that they might be licking their wounds, say 1 year or 2 years down the line. And why is that? NPAs could be back ended. So what will happen is NPAs do not show up right now. There's a case where you have a situation where some NPAs are written off, some NPAs are not there. But 2 quarters down the line, 3 quarters down the line, you will see the stress coming in of the pandemic that is taking place at the moment. So because the market has already priced in FY21, it is not to say that FY22 will be all rosy. There could be a situation that the vaccine may come in July, may come in August, and it will take probably December of 2021. By then, probably 10-20 crore of people would have the vaccine. By 2022, we'll all have the vaccine, and things will get back into probably proper place, and things will be back on track. But FY22 could also be not that great, and at that point of time, with the bank nifty at 30,000, from being at 19-20,000, then the selling will begin, because people have priced in FY21 but have not priced in FY22 for most of the banks. Another thing is, it is very hard to know what is the real book value. So people talk of book value. Many mid cap, small cap banks do talk of book value. We have had a situation in Lakshmi Vilas Bank just recently. We have had situation with large banks like Yes Bank. We have had rumors with Axis Bank. That was just rumors, but we are hearing a lot of things about a lot of banks here and there, and it is extremely hard to ascertain as to what kind of book value the banks are having. And it is the most important thing when you're valuing any bank, that whether it is trading at 2 times, 4 times, 3 times or not, or half time book value. But then what is the book value? We have to be certain about it. Very uncertain on the fact, there's high level of uncertainty on the kind of business the banks are having, what kind of loans that they have given, are they shielding any loans or not, are is whatever in the public domain is what they are doing, or there is something more to it. We have seen what happened with the HDIL fiasco, the kind of loans that were given by one bank to the company. 70-80% of the loans were given only to HDIL, and so on and so forth. So for retail investors, it is very very difficult to track, virtually impossible to track. It is better to track a biscuit company or a milk company or a chocolate company, rather than tracking some banks here in India. And that is why I would say these are avoid. Loan books are shady for most mid and small cap banks. I'm not talking of large caps, but many mid and small cap banks, many, you can say, public sector banks, their loan books, we don't know whether the loans, they'll get the payback in time, they'll get it, whether how much would become NPA, etc. And this is another concern. So with so many complications and concerns, it is better to avoid. This is another sector that is dependent on growth, so you have to understand that. So you have to understand that this is another sector that is dependent on economic growth, and probably when economic growth comes in, all these sectors to which the banks have lended to, so whether it was infrastructure, real estate, capital goods, and other companies, especially in the real estate space, if things really get going, these banks will perform, because these are the loans that become NPAs. The loans to publics or the loan to common people do not more or less become NPAs, and that's why a company like Bajaj Finance keeps going up, whereas other large banks do not. So this is the biggest reason. So very complicated animal to tame, a very complicated sector to understand. Yes, of course you can trade, so I'm not saying you cannot trade in these stocks. You can trade over 1 or 2 months or 3 months or few days, but you cannot invest over time and think that you will generate wealth by investing into most banks. Next sector, and this is related to banks, but this is different. This is into finance, microfinance and NBFCs. Again, a business apart from Bajaj Finance, which is doing well. 99% of these businesses do well when economy is doing really well, especially rural economy when we talk about microfinance. And that's why most microfinance businesses or stocks really did well from 2014 to 2017, because that was a mid cap small cap mad rush that was taking place. And we are having the same here, but it's of a different tone altogether. Probably 2021 will see NBFCs microfinance may go up for few months, but you never know when the tide turns. And whenever the tide turns, we have situations like DHFL, we have situations like many microfinance companies going completely, you can say, belly up, completely bankrupt. And we don't want such situations with our investments. We want steady returns, and this is why this channel is here. So Simply Stocks being a channel here, kindly subscribe to it. We talk about investments or stocks which can grow over time, be it in a very slow manner, and then can probably explode later on with some external, you can say, benefits. But we don't want a situation in which we get into companies where there is debt, where there is chances of NPAs, etc. And the same is here with microfinance. Rural stress currently is none, but will may come back with say low monsoon for 1 year or 2 years, and then we'll see the stress in that space. Currently everything is very gung-ho about rural, and we are seeing even tractor sales and you can say lending going up. So those companies are doing well, but I believe that this is also a cyclical sort of a sector in which performance only comes with monsoon, and there are a lot of factors engaged to it. Loan laden hurdles are there, debt ridden businesses, uh, uh, and you have to understand that private banks are taking all market share. Microfinance and NBFCs may do their bit, but there are large private banks who are also getting into this space. So over time, this is what will happen, that most of the microfinance and NBFCs will go down the path of what others have done over the years, and these large banks will keep on getting more market share. Remember that this sector per se is directly related to and dependent on robust rural growth. So this is completely dependent on rural growth. It has to be good for these companies to do well. May not be a consistent and compounding growth story. It may do well for 1 year, 18 months, and you have to get out. So in my opinion, in these cases, that's like a trade for me rather than investment. And we don't know which quarter they come out with, or which quarter which company would come out with NPAs and difficult numbers. So we have to be careful on that front. A mistake may lead to capital wiping out like we had in DHFL, and that is my major concerns with most banks, and especially with microfinance and NBFCs, that you buy a company for 100 rupees and becomes 20 rupees within months. Your 70-80% of your capital is wiped out, so you have to be careful in that regard. Okay, and this is another space that I would like to avoid, and this is commercial real estate, especially because of the work from home, which has become the latest hurdle, apart from the rental income going down, apart from the fact that these companies are also debt laden a lot. So at 8%, you can say country growth. this sector or stocks could perform because of the kind of debt the companies have. But currently what is happening, that commercial real estate spaces are not being taken up. In fact, many of the commercial real estate the spaces have been vacated by most of the, you can say, offices or most of the companies, in lieu of the work from home that is going on. And many IT companies, you can say technology companies, would continue to go for more work from home rather than renting spaces for their employees. They are liking it because they are saving a lot of cost on rental incomes, on say rental expenses or real estate expenses. And you can say employees are loving it because they are staying at home and doing their work and earning. They don't have to move around, they don't have to spend for petrol, they don't have to spend a lot for taking care of their vehicles, etc. I think this feature will continue even after the pandemic ends, even after things normalize. At least 20 to 30% of all, you can say, workforce that were working from offices would work from home. That's my assessment, and that's why this is a sector that could face real trouble going forward on a futuristic basis. It's debt laden, that is all to see, and issues of corporate governance are there in real estate. So we have seen what happened with the Vadhavans, we have seen what happens with HDIL, we have seen what happened with other stocks in this real estate space. There are always rumors, there are always talk of corporate governance issues in many companies. So it will remain out of favor with large investors. Yes, there could be some trading plays. Again, I'm saying that these are good, you can say, sectors to trade into when things are looking good. You can buy for 2 months, 8 weeks, 12 weeks, and then make your 20%, 15-20%, and probably get out, and just like that. But not an investment bet, the commercial real estate would be. So this is a video on the 5 sector that I believe that should be avoided. Kindly do write what you feel about these 5 sectors, and please like and subscribe my channel and hit the bell icon so you can get my videos straight away when I post it. Thanks a lot for watching.